Bonjour à tous.
Good morning, everyone. Welcome to the presentation of FY08 earnings of the AXA Group, presented by the head of the Management Board, Henri de Castres, and Denis Duverne, in charge of strategy, are present also for the Q&A at the end of the presentation. Claude Brunet, in charge of transversal operations, marketing, communication, and HR. Freddie Bouquert, head of Northern, Central, and Eastern European region. And François Pierson, head of AXA France. Henri de Castres, the floor is yours. Good morning, everyone. I'm going to try to be as concise as possible in presenting the earnings for fiscal financial year 2008, which, as Emmanuel has just said, will be shared between myself and Denis, and then we will take your questions. I imagine you will have a few. If what did this past year look like? You all know that it was impacted by a financial storm, which is without precedent in our history. And we'll give you some examples in a few minutes. Of course, AXA was impacted, but AXA also resisted. Why did AXA resist? Well, if you look at our results in a global manner, our underlying earnings, what we control on a daily basis, of course, dropped, but it dropped to a level which is equivalent to that of 2006, which was the year's second best historical year from an underlying results standpoint. But maintaining our result is at very historically high, over 4 billion euros, which means that even if there was a storm, our businesses stood up to the storm. The results are different according to the different areas. In P&C, we had a record year. In businesses that are more impacted by financial markets, such as asset management and life insurance, of course, our results are down to levels that are far from negligible, but remain still synonymous with profit. And as a whole, the group demonstrates profit over financial year 2008. Net income has dropped more significantly by approximately 80%. Dropped because, of course, underlying earnings have dropped because the unrealized capital gains are less significant than last year, and that we were, as regards our adjusted earnings, in a position where we had to here accept certain depreciation as far as certain of our assets are concerned. And also, we also have here high-quality shares on the market, but IFRS standards lead us here to implementing impairments which we consider to be much more accounting than they are economic. If we were here to restate the net income on the basis of these impairments, it would still be at 2.8 billion euros. So we have dropped, but perhaps less strongly in this area. A year where our earnings perhaps have suffered, but where our profitability level, is maintained, and our asset management approach remains a very operational financial model, although we are impacted by what happened to the financial markets. During the financial year, we have done everything we could to protect our profitability by changing the pricing modalities of some of our products, by also implementing economic measures in some areas, and by withdrawing risk from our balance sheet through hedging approaches. We are aware of the situation which we are expecting to see evolve in financial year 2009, although we have less visibility. We are confident. We are confident because our balance sheet is strong. Our solvency ratio that we will share with you is one which has indeed dropped, but that is what solvency ratios are for. They fluctuate based on the general situation. Today, our level is lower than that of beginning 2008, which is not a surprise, but it is yet still way above regulatory requirements. So we have no anxiety in this area, strong balance sheet. And secondly, the group's operating model is one where we continue to bring in new clients every day. In 2008, we have increased market share, and we believe that this will also apply to 2009. Now, to go into detail, first of all, our environment. We have tried to summarize on this sort of radar screen what in fact happened in 2008 from a financial standpoint, which impact life insurance and asset management businesses. As far as markets are concerned, we have recorded here the worst performance since for the past 183 years. Two very bad years, I think 1931 and 2008. So you can see that we are here on the left end of the first graph. Secondly, volatility. Volatility of our markets certainly has beat its own historical records. This graphic represents here the Everest height of volatility. This certainly was exceeded in the last part of last year. Credit spreads and risk-free rates and what corporations pay, increasing their debt level on the market to be able to finance their investments, have also reached record highs, which certainly generate some accounting provisions. Although debt gearing is healthy, these spreads are very, very high. So if you want to sell what you own on the market, you sell it very much under its nominal value, although the company, of course, is still withstanding the shock. And these rates are at their lowest since 10 years. So most of the financial markets are either highly negative or at levels which demonstrate very deep-rooted malfunctions, and all financial institutions have been impacted as well, to a higher or lesser degree. What is the impact on AXA? We have, in fact, been able to resist, but in a certain number of our business areas, we have nonetheless, let's say, suffered or recorded changes which are not positive without this challenging the robustness of our vessel. Now, where are the impacts as far as AXA is concerned? Very extreme volatility levels on our equity markets, impacting strongly our American activities, where we sell life insurance products with guarantees for our clients. We believe in the health of these products in the long term. What happened in 2008 is, if you will, a historically exceptional situation. This has had an impact on the cost of hedging that we take out for these variable annuities. And on this basis, the American earnings themselves have been strongly impacted. Secondly, the drop in the equity markets also has impacted assets that we manage. We are one of the main asset managers worldwide. We also sell insurance products invested in equity besides these variable annuities, and the drop in the value of these assets have led to lower commissioning levels than was the case a year or two ago. This is the second form of impact on AXA. The third impact, I have mentioned this a few minutes ago, is here the widening of credit spreads, which have a very negative impact on net income because we need to put in adequacy here corporate assets. And this, in fact, may be very widely artificial, which will be corrected over time. But nonetheless, standards are standards. We need to apply them. And this leads us to reflecting more deeply on the typically cyclical aspect of some of the standards that have been implemented. But this is not specific to AXA. First of all, now, our revenue, because if a company exists, it is to serve its clients, to sell products, and the best way to measure the health of a company over the long term is to see whether it is capable of acquiring clients or whether the first crisis leads to loss in clients. Our revenues have dropped slightly versus last year, but have grown in P&C and in slight regression on other business activities, simply because new business was a little more difficult to obtain in life insurance. But if we compare our revenue versus those of our competitors, competitors, we have either maintained or won market share on all of the markets where we are present. This, in my opinion, is very important because in this crisis environment, people will suffer and resist, and others will not resist. We are part of those who accept to suffer, but who can withstand the shock better than others. P&C, over the group last year, we have brought in over 1 million new contracts. I do not believe that everyone can boast of the same situation. And this is the result of the quality of our products and also of the efficiency of our operating model, which is one based on global distribution. Here, of course, our underlying earnings, 4 billion euros, high up management guidelines of last year, is above what it was in 2006. Now, of course, the way it is composed is slightly different. P&C is at a significantly higher level, and life insurance has decreased for reasons I've already explained. The strength of our balance sheet, surplus of 6 billion euros, according to the Solvency I standards. And I think that as far as this is concerned, people should learn to relax. People are slightly frenetic today in the financial world as regards solvency. Solvency is, in fact, the capital invested as a counterpart to the right to do business. This is something which is determined by legislators, regulators. This is your driving license, so to speak. Our driving license is very clear, with a notable surplus in the points associated with the driver's license. So I would say that we should relax by saying that even if the situation would continue to deteriorate, we have set up certain defense lines, and we will describe for you this morning additional defense line that we have available to us that we would impose if need be, but we are relatively serene. We have to reduce, although our heart breaks, the level of our dividends. It will be here of 0.4 euro per share because our adjusted earnings have dropped. Net income also in significant proportions. And in these high volatility and high uncertainty periods, we would like to continue to defend the robustness of our balance sheet, remunerate our shareholders at a reasonable level, and give them trust in the future, but apply an attitude which we could qualify as cautious. To return to the details of our environment, if you look at our total revenue per business area, this reflects what I said, a slight drop in life insurance, an increase in P&C, perhaps a more pronounced drop in asset management because commission levels have been directly impacted by the drop in markets. If we now look at the geographical spread of our revenue, we can see here from a practical standpoint the virtues of a diversified business model. In Asia Pacific, growth remains positive. Continental Europe, our revenue remains stable with positive performance in Eastern Europe and Mediterranean area, whereas in the US, the situation was more difficult. But when we look at this graphic, we can see that diversification is a wonderful shock absorber. Now here are the underlying earnings. I've talked about it. I would like to return to P&C combined ratios. I'd like to remind you of the fact that in 2008, this was at over 114, which means that when we brought in 100 in premiums, we were able to we paid out 114 in overheads and claims handling fees. So this was not what we could call an optimal situation. Today, financial capital gains perhaps are not as exuberant as they were in 2000, but our technical results are extremely solid because the ratio today is at 95.5%, which is the best combined ratio historically reached by the group. This is the result of satisfactory profitability on this year's business activities, and that also traditionally we have very conservative provisions which allow us to put them in action reduction whenever necessary over time. When we look now at the spread of these underlying earnings, we can see the virtue of diversification. One which was particularly difficult was, of course, United States, where for the first time since 1991 we're losing money. Why? It doesn't mean that the company all of a sudden is malfunctioning, quite the opposite. We have maintained our market share. The products we sell are good quality products. The team we have is recognized as being an extremely competent team in the U.S., but the cost of hedging that we need to take out to offer guarantees to our clients has exploded in 2008 in view of volatility, and we bear the scars. Everywhere else, our results are usually positive. We can underscore here the excellent performance of France, which has resisted quite strongly to the storm, with an increase in its earnings of 35%. Excellent performance of the Mediterranean and Latin American region, where we have seen a hike of nearly 50%. So once again, diversification equals strong resilience to shock. Now here we have the adjusted and the net income and the dividend. The adjusted earnings here involve the underlying, and to which we add the plus or minus of the realized or unrealized capital gains. Net income lower for reasons that I described earlier on. And here again, I would like to underscore the impact of these accounting standards, which lead us to applying impairments on the different equity, which also means that we need to shorten the management horizon of our businesses. And you will hear Denis tell you later on that the group's portfolio, which was around 30 billion at the beginning of 2008, is now only at around 7 billion euros. Why? Because to avoid too high volatility in our earnings in view of the evolution of these accounting standards, all of the major institutions are reducing their investments in equity markets. So this is why what we see today is not a surprise, because the accounting standards are, of course, very short term. If you buy a share on January 1 and that June 13th it has dropped in value, it is something you need to provision for, although you may technically be able to keep it for a longer period of time. So there is a topic which involves the quality of the standards contributing to the current crisis and to the lack of stability of our financial markets. I've talked about the dividend already. To return to the global environment surrounding us, and I would say to the topic of the fact that during the crisis, business activities are pursued. We brought in over 1 million new contracts in P&C. In life insurance, although the result has dropped, net inflow remains quite significantly positive, and we have brought in over 8.4 billion euros in positive net inflow. So this is 8 billion net over 2008, which is far from negligible in terms of business performance. We have strengthened our expertise. As you know, we are very active in quickly promoting those who are successful within AXA, and to attracting to AXA those who we believe in. Three very symbolic examples here. First of all, Peter Krause, who is now the head of AllianceBernstein in the U.S., who is a specialist recognized for the quality of his management, who used to work for Goldman Sachs and who has decided to join the group to deal with the asset management business in the U.S. We're very happy to welcome him as well. Mike Bishop now is in charge of life insurance in Southeast Asia, who used to work with Prudential. And the third element here, the appeal of AXA for Eric Cheney, who was head economist at Morgan Stanley, who is now with AXA. So some seem to be more resilient, more robust than others, but very high-level people come to join us because they feel, and I think they're right, that we will partake in the consolidation of our sector in the coming years. We also here have recruited over 5,000 distributors in 2008, demonstrating our long-term trust in all of our businesses to grow our commercial presence on the market, and we have maintained our investment programs in training, international mobility, promotion of talents, because we believe, of course, that we need to hedge against the crisis by applying specific measures, but that we must not, during this period, sacrifice our long-term position. Another element which, in my opinion, is essential in these high uncertainty periods, two components are essential to maintain our presence in the long term: the trust of our clients and the engagement of our people. And here it is our satisfaction to be able to say this morning that every year we have very detailed annual surveys, and we have made significant progress in 2008. Client satisfaction, for example, we are up 2 points versus last year, and we have earned 4 points as regards the engagement of our people. And this is an extremely important situation. The fact that our clients are faithful to us and that our people, despite the crisis, are much more able to demonstrate stronger capacity for effort are two components which are much more important to my mind and to the group than the volatility of the markets we're facing now. And Dennis is now going to give you more details. Thank you, Henry. Good morning, ladies and gentlemen. I'm going to continue this presentation, first of all, with a brief summary, but you've already heard Henri mention this. Strong maintained underlying earnings, 4 billion euros, adjusted, impacted by long-term depreciation for impairments on shares and bonds, and net income impacted by, of course, here the mark-to-market value. And we can see here shareholders' equity at 37 billion euros, suffering from diminution of 5 billion euros as regards unrealized capital gains. Now, if I look at the analysis here of our underlying earnings, you can see that it is contrasted, and we mentioned this. Life and savings down 43% to 1.5 billion. P&C up 31% to 2.4 billion. Asset management stable at plus 6% at constant exchange rate, and I'll tell you why. International insurance down by 21%. And finally, bank relatively stable, and holdings dropping essentially due to the increase of our debt level associated with the acquisitions undertaken in 2008, i.e. Russia and Mexico, and of course Turkey. If I now go into greater detail as regards the underlying earnings in life and savings, this graphic may be slightly complicated to read, but it explains how we make money in life insurance. You can see on the left-hand side our gross margin, which involves three components. Of course, a margin on our revenue at 4,281 million euros, up 3%. On a comparable basis. And then, of course, margin on assets under management, 5,052 million euros. So due to unit-linked products, these average assets have recorded a slight drop at 6%. And the technical margin, which corresponds to mortality, morbidity rates, and annuities, and the result of our hedging on our unit-linked products, essentially in the U.S., has gone from a positive result at 1.4 billion in 2007 to a negative result of 51 million in 2008. So you can see that the drop in our gross margin stems from these issues resulting from the hedging of variable annuities, essentially in the U.S. As far as expenses are concerned, you can see acquisition expenses at 3,185 million euros, down 4%, because we have new business that has also dropped. Administrative expenses of 3,678 million euros, up 4% because our business stock portfolio in life insurance has continued to move on. Also here, amortization of our portfolio value up 25%, 440 million euros, giving us an underlying earning pre-tax of nearly 2 billion euros, a drop of 50%. A tax of 314 million, a drop of 70%, and of course, after minority interest, here our underlying earning down 43%. Now, if we look at P&C, and here you can see that the landscape is totally different because, as you remember, we have seen a progress of 31% in our earnings. An explanation on how we calculate this. On the left-hand side, the first component of the income is the technical result, which is the result of the multiplication of our revenue by the combined ratio, or the inverse of this combined ratio. It has dropped by almost 2 points and is now at 95.5%, where the net technical result demonstrates strong leverage with a growth of 97% to reach 1,153 million euros. Now, in P&C, what is very important here is the financial levels, which correspond to a 4% in average assets, multiplied here by the average yield, which was around 4.2% in 2008, up 8%, giving us financial revenue of 2,253 million, up 13%. Therefore, here an underlying earning pre-tax at 3,406 million euros plus 32%, giving us here earnings at 2,394 million euros. If we now look at the evolution of our P&C business in the different regions of the world where we are present, you can see that the growth is covers almost the entire board, with the exception, of course, of North America, simply because the different countries also here in the North European and Central European regions, Germany, Switzerland, Belgium, for example, exceptional combined ratio at 93%, down 4 points. Strong increase in revenue here in Mediterranean and Latin America because we've integrated Mexico, 6.4% growth on a comparable basis, demonstrating that there are emerging markets in this region which have been extremely resilient as far as growth is concerned, with very good combined ratio at 93.3%. No growth in the UK with an improved combined ratio because the storms and floods of 2007 were not recurrent this year. And you can see that in all, our revenue has grown, and the combined ratio itself has improved by 1.9 points. Here, asset management impacted by unfavorable market conditions. Here again, an technical explanation on the way in which we calculate our results in asset management. Here, our revenue is the produce of the average commissions of assets under management. 36 basis points dropped very slightly, -3%, because the proportion in shares have dropped and that commissions are higher on shares than on bonds. And the average assets under management of both of our asset managements have gone down 8% at 970 billion euros. These are average assets, of course. You can see there's a very strong difference between assets at the beginning of the year at 1,092 million euros and at closure at 816 million. So we will see another impact of this drop in assets in 2009. So the result of our management commissions through assets give us here a result down 11%. Now here, to this particular revenue in asset management, we need to add distribution revenue, 448 million euros, a drop of 32%, where we have had less sales of asset management services in 2008 in view of the crisis. Financial result, 15 million euros, not significant. And this, of course, is to be equated with expenses. Expenses for asset management, 2,313,000,000 euros, minus 10%, and distribution expenses, which will be approximately equal to the commissions that we remove for distribution, down 23%, which gives us here an underlying earning pre-tax at 1,175,000,000 euros, down 15%. But our tax load has also dropped strongly, minus 34%. Due to exceptional effects in 2008, which were favorable, which means that here the underlying earnings at constant exchange rate has progressed by 6%, but you can see that the trend is nonetheless negative in view of the drop in assets under management. Now, our adjusted earnings based on the underlying earnings of a little above 4 billion euros. We here have adjusted earnings down by 39% to 3,700,000,000 euros. The reasons behind this drop, well, first of all, net impairments here for asset depreciations involving essentially equity. You can see that we have provisioned nearly 2 billion euros for equity. Now, let me remind you of the fact that we apply fairly rigorous and mechanical rules for long-term depreciation of our equity. Now, if one of these equities drops by 20% or has dropped for over 6 months, we usually here, of course, cover this with impairment. So I think that versus our competitors, we are the most rigorous in our approach. As regards bonds, we have also provisioned here of 500 million euros. These provisions were partly offset by our equity portfolio hedging measures that we have implemented locally in our life insurance company since 2007, which have brought in 301 million euros in 2008. And as far as AXA SA is concerned, where we implemented in May, June 2008 a macro hedging program over 14 billion euros, brought in 1,335,000,000 euros. So this hedging has partially offset provisions or impairments, but this hedging was not perfect, and partially because the product of hedging is taxable and provisions are not always fiscally deductible. Now, net income, Henry mentioned this earlier on. We have tried here to break down this net income into two different components because the net income itself has dropped very, very sharply. But part of this net income does not, in our opinion, represent a sustainable economic reality. Now, if we cover the 3,700,000,000 in our adjusted earnings, we need to take into account the change in the fair value of asset-based securities or, in fact, structured products. And here, again, it is quite possible that this may last. Secondly, the change in fair value on equity and alternative investment instruments, 447 billion euros, this may also be sustained. And this gives us an economic result of 2.8 billion. Now, what are the components composed of? First of all, we can see here a variation of fair value impacted by the widening of credit spread on our corporate bonds. Our corporate bonds are part of a category that we call AFS P&L, or available for sale through the P&L, or also fair value option. You remember that in October, USB allowed the banks to reclassify their trading portfolio in loan portfolios. The insurance companies are not involved in trading, so they do not have this possibility, but they have put their bonds portfolio in the fair value option. Insurance companies asked the same of USB, but their answer was negative. So here we have this bond portfolio possibility, which is impacted by the change in fair value, and we have here 1.5 billion to put in our results. Secondly, for 222 million euros, variation of fair value of balance sheet hedging instruments. Here, of course, we have derivatives, which cover some of our balance sheet items and which are not qualified to be included in the hedging policy, so we take them on the basis of mark to market, although they have a positive position in our balance sheet. And the third element, of course, here involves other changes in fair value of other assets and derivatives for 144 million euros. So this brings us down from 2.8 billion to 923 million euros, but we do not consider that this represents an economic reality for the group, but is only an accounting impact. Now, shareholders' equity. Shareholders' equity were at 45.6 billion at the end of 2007 and are now at 37,440,000,000. Negative here by the dividend paid in 2008 for 2008, 2,473,000,000 euros. Share plan and stock options for 711 million euros. In negative position here, and this is the largest item up to 5 billion because of the variation in unrealized capital gains, and also negative by the impact of change and other for 2.275 billion euros. So we have seen here variations, of course, in exchange rate throughout the year, and there is an impact because we cannot cover the totality here of our balance sheet. Now, if we look at this slide at the bottom, there are two comments I would like to make. First of all, we still have unrealized capital gains that are not in the balance sheet, essentially for real estate and loans, which reached 3,400,000,000 euros, up versus the end of 2007. Secondly, in view of the unrealized capital gain changes in our balance sheet, they have gone in net from 4.8 billion in 2007 at minus 400 million at the end of 2008. And here you can see the glass half full or half empty. Half empty, you no longer have unrealized capital gains in your balance sheet. You are at minus 400 million euros. The glass half full involves two components. First of all, we have 500 million euros in net unrealized capital gains over equity. And then we, of course, have the real estate aspect on the balance sheet. And furthermore, if we compare our position to that of a certain number of our competitors, our balance sheet here based entirely on market value, we end 2008 without unrealized capital gains. And we have some competitors who are in the reversed position. Now, as regards the 2,700,000,000 item here on the right-hand side, we also can see the impact of the increase in the deficit of our pension funds for approximately 700 billion euros. And there is an impact regarding our perpetual debt, which involves the interest load on this debt and an exchange as well. Oops. No sound. No sound. No sound. I'm sorry, I can't hear. I cannot hear. I'm sorry, no sound. There is no sound in the booth. Hello? No sound, no sound. I have no sound, ladies and gentlemen. valued at December 31, 2000, in mark-to-model and mark-to-market, because market transactions were rare and were therefore not significant. The impact of this passage from mark-to-market to mark-to-model represent a high number of euros, which means that if we had considered mark-to-market more significant than mark-to-model, would have represented, let's say, 200 million in earnings. The group's treasury has gone to 300 billion euros, and our equity have gone from 37 to 17, meaning this only represents 4% of the balance sheet. Henry mentioned earlier on 7 billion. 7 billion corresponds to what is left to the risk of our shareholders. We have local hedging measures implemented, some of our equity portfolios in companies where there are minority interests. So what is left in the equity portfolio is only 7 million euros on a general fund of 390 billion. Now, we can see that alternatives are stable, and the loans too are also stable. Reduction here in the weight of equity in the group's balance sheet. Now, if I look at our solvency, the one that is still applicable at the end of 2008, after payment of dividends, the dividends that we will pay in May, 127%. If we now apply the Solvency II requirements based on the criteria of the last quantitative study, QS4, undertaken by community authorities at the end of 2007, let me remind you that we were at 170%. At the end of 2008, we are under 145. So you can see that Solvency II requirements demonstrate that our position is less volatile than under Solvency I. What can happen in 2008? Well, of course, our underlying earnings at the same pace as 2008, so in 2009 rather, can increase by approximately 18 points. We can see here sensitivities which are reduced versus what they could be. Sensitivity to variation of 10% on equity markets of approximately 3 points. Here a credit default minus 3 points, and if 1% credit default 10%. Between plus 10 and minus 10% in real estate, plus minus 6 points, and plus 10, minus 10% private equity, 2 points. So after the annual shareholders assembly, we may be in a position to apply complementary measures, because we are submitting to the shareholders meeting the possibility of issuing preferred shares if necessary to increase the group's financial margin. These preferred shares could be made available to AXA mutual companies and or to shareholders and or to other institutional investors and or to the general public for a accumulated issuance amount, mutual or other shareholder for 2 billion euros. Annual estimated cost, the dividend for these preferred shares would be situated between 1.2 to 1.8, with here a ceiling of 10 to 14% and a threshold of 6 to 8% made available and established at issuance if this was required. Thank you for your attention, ladies and gentlemen, and I will now return the floor to Henri de Castries. Right. I'm going to very quickly conclude so that I can give you time for questions. You can see what do our results demonstrate? Resistance in our business in the face of a storm that we have, such as we have never known. Very solid position, a relatively strong economic uncertainty, but that's life. And this will lead us to reflecting upon how we will now manage the group in such an environment. It seems difficult to do on a daily basis, but fairly simple, fundamentally speaking. One, we must not change our strategy. Our positioning in our business areas is a good one. It has demonstrated its resilience in 2008, and we will continue to maintain the same course. So our businesses, life and savings, and of course P&C and asset management, we will try to maintain our position, see how we can increase our exposure on emerging markets with caution, and by attempting to take advantage of a certain number of opportunities which will certainly occur, because there will be players who will need to back their assets or perhaps to sell some of their assets. We will not change the group's strategic position in each of our business areas, life and savings, asset management, P&C. What do we try to do on a daily basis? We try to improve our product offer. We have to change some of our prices because in such high volatile contexts, guarantees are more expensive to produce than before. So there are products for which we have to change our prices, products that we have to put on the market because they correspond to today's clients' concerns, and particularly as regards their search and quest for guarantees and for long-term guarantees in particular. And of course, as regards productivity, we need to continue to attempt to make more savings. This is what we will do in a very serene approach, despite external turbulences. And once again, we can do this because our model is good and our balance sheet is strong. Financial services are impacted, but I do not think that we should throw the baby out with the bathwater. The quality of what our people do, the amplitude of the needs of our clients are such that at some point, the situation will be calmer, and we will continue to apply what we've done within the framework of our Ambition 2012 program. And we are certain that we will emerge from this crisis holding a strong position as consolidator of our business. Once again, we are not here to complain. We are here to do battle, and we will do just that. Questions? Yes, there's a question at the back of the room, I think. Good morning. Anne de Giel, Figaro. Could you return to your bonds position, please? On CDS, about 19 billion euros, if my memory serves me right. It hasn't fundamentally changed, and it corresponds to the group's position in the past years, which was to complete our exposure in treasury bonds with a stronger level of exposure to CDS bonds. So this, of course, has led to negative mark-to-market positions, which are reflected in our net income, and I don't think there's anything else I have to add on this score. Any other questions? Yes. Fabien Benedetti, Bloomberg. On the AIG issue, you had expressed a potential interest beginning of October. Since then, things may have evolved a little bit. Where do you stand today in this area, particularly on Anico and the UK and Japan activities of AIG, or the other Asian activities of AIG which are on sale today? And how could you finance such an operation? You know, we never make specific comments on a specific project. We never do it, and we won't do it now. What I would like to say is to confirm what I said 30 seconds ago, which is that, in fact, we remain vigilant as to the opportunities which could come up that are aligned with our strategic choices. Yes? Good morning, Le Monde. Several questions. Number one, your dividend is below consensus, and furthermore, we can see a preparation of a capital increase if needed. Does this mean that AXA is preparing for the worst, despite the robustness of its financial model? Also, French banks have been massively supported by the state. Have you already noticed competition that may be slightly impacted? And also the results in Germany, I can see here the income, but I don't have the country per country result. On the third question, we will be able to give you details. As far as your two first questions are concerned, our business is to manage risk and to have a very wide range of measures to apply, which does not mean that we will apply them all. When you take out life insurance or motor insurance, it is not because you intend to have an accident or the intention to die. It is because if this should happen, you want to protect your family or you want to be able to repair your cars. Well, it's the same thing for the company. Of course, the dividend is lower than last year, but so is the income. And yes, we want to maintain a strong financial structure. And in this period, what we believe and what our shareholders are asking for is reasonable remuneration, lesser than last year, of course, but and we do not want to have to apply this defensive measure that I mentioned. This is just something that we are proposing to hedge against potential risks. Now, as regards banks and support for the... Yeah, I'd like to make one comment, says Denis Duvergne. You've talked about capital increase. It's not capital increase. The issue of preferred shares is a hybrid instrument. And technically, we can say that it is part of the capital, but it has a much less dilutive impact than capital increase. Could you go into technical details, asks Henry. Well, when you issue preferred shares, these shares are subordinated to all debts, but are also senior versus the other share of the capital, and which impact a priority dividend, but which also has a ceiling. So we have not said that we will issue them. We will be asking the shareholders meeting for the possibility of doing so if the need should arise. What we're doing, ladies and gentlemen, says Henry, is taking out an insurance. Now, as regards banks, 3 points. First of all, French banks, as shown by the results that two of them have put across the board, demonstrate that their health is much better than that of other banks worldwide. And I think this is something we should be very happy about, despite this unprecedented situation. Yes, it is true that the state has made funding available to them for additional credits. Do we see competition distortions? Not on the French market. What we could be more preoccupied with is the idea that in a certain number of other countries or business areas, such as bank insurance or even insurance companies, states make available to these companies funding possibilities that are quite significant, which may, from time to time, lead some of these companies to apply pricing policies that I would qualify as being aggressive and totally unjustifiably. Of course, this may be necessary in periods of very acute crises because this contributes to stabilizing the system. It's a little bit like the intervention of a fire brigade. We're very happy to see them come when there's fire at home because then they turn out the fire, but then we need to be extremely careful for several years following the fire as to damage from water. I would like to add that as far as P&C is concerned, this is a preoccupation for us, but it is even a greater worry for us in life insurance in view of the current positions of our markets. As in external growth operations, we never give specific names. And your third question involved Germany and life insurance in Germany, if I understood you properly. No, it was P&C. Now, P&C in Germany, the underlying earnings, 458 million euros, up approximately 20% versus last year. Net income down in view of the evolution on our financial markets. As far as life is concerned, life insurance, volumes were stable, up 1%. Results have gone from 321 million euros to 106 million, here again impacted by the issue of variable annuities product hedging, such as Tristar, for example, for which there was a difficult moment during financial year 2008. And you have this in the press release and in our management report. Yes, Angela Henriques, Tribune de l'Assurance. I wanted to return to variable annuities. This cost you as far as your margin is concerned. I want to know whether you're going to increase your price or review the model you apply to this type of product. Both, says Denis. At least in the US, we have launched a product with modified guarantees in November 2008 and in February 2009. But the most important component here is the modification of the underlying funds, because what cost us the most was, of course, the volatility and the basic risk. The basic risk means that the funds in which our clients have invested money had a fairly different and poorer performance than those of indexes. So we have here matched this to the performance of index-based funds, and there we have eliminated almost 2/3 of the basic risk with the change in the situation that we saw in July, August 2008 and the end of the year. So we have strongly reduced the risk of seeing the same event reoccur in 2009. But we have also modified the prices of our products in November and February. Lionel Garnier, Le Revenu. As regards variable annuities, the hedging that you announced, or at least the provisions that you've mentioned, exclusively concern the American market, or what was done in Europe precedingly? And are the hikes of these hedging prices sustainable and will therefore make it necessary for you to sustainably modify your offer conditions? Secondly, as regards the capital gains in real estate, ex-balance sheet, they increase. It's a surprise. What is the mechanism that can explain the increase in capital gains? And secondly, the hedging of your equity portfolio. There was a fairly spectacular shock absorber in 2008. Could you give us a few words as regards your hedging policy in 2009? Thank you very much. As far as variable annuities are concerned, once again, what we were submitted to was very high volatility, which remains very strong at the beginning of 2009, and which, of course, justifies a slight increase in hedging prices. And secondly, basic risk, which showed up in U.S. numbers and a little bit in Germany as well. But I would say that ex-U.S. and ex-Germany, the result was very slightly negative, but does not justify in itself any price modification. What justifies price modification is the strong drop in interest rates, which of course is impacting here the profitability of life insurance products beyond the issue of variable annuities. The principle of these products is not, of course, challenged negatively, so we have restated all the issues that we were confronted with, except that of volatility, because we believe that volatility will not indefinitely remain at the level that we can observe now. And therefore, we believe that these products are good for our clients. They're good for us, and that we have, in fact, largely covered the issues in 2008, and we believe that they are far behind us now, with the exception of volatility, of course. And now, as far as real estate capital gains are concerned, our exposure in this area is essentially in France and Switzerland, and more marginally in Belgium, Germany, and US. We have, in fact, here noticed an increase in our real estate unrealized capital gains, essentially on the Swiss market, if my memory serves me right, which is a market that has remained quite stable over the period, and the unrealized capital gains have dropped on other territories. Now, as regards here the hedging of our portfolio in general fund equity, we have left in our life insurance companies in the group that have demonstrated profit. The situation here has been solved. We have dropped the levels, and that these approaches are now non-economic, and Henri Decazes did mention a residual level of several billion euros. So in view of the cost of this coverage and the impact this can have on our solvency, we believe that this was in fact an insurance contract that we didn't need to take out to protect ourselves. Another question. Yes, Géraldine Viel, Les Echos. Your client satisfaction index is positive, and I think that this was one of the two criteria for the issue of free shares. Could you please tell us what you have decided now? Well, we won't. We won't distribute free shares. We needed to cover two criteria. The first is results, and secondly, although client satisfaction has increased significantly, is still under, very slightly under, the objective we had set for ourselves. So we will not distribute the 50 free shares. As a matter of fact, we will put them back in the game on the coming financial years. Now, more technical question. You have insisted on the fact that your combined ratio was historically low. Is this due in part to recouping provisions on the preceding years? Yes, well, these do exist, but if you look at the presentation that we will be making in front of the analysts, you can see that we do this regularly, and we are now at a stage in the cycle where it is absolutely justified to see their slight increase. So yes, this is a position that we have taken, but this is still very healthy, because one of the group's positions is to always be quite conservative. And at some point, these positions, conservative positions, require that the provisions transit through our results. And there's also an important component as to the drop in our combined ratio, which is that floods and storms in 2007 were very, very important in their impact, and 2008 was more serene in this area. Another question? Now, as regards preferred shares, if you are given the green light to issue, will there be a refund clause when you decide to apply it? Preferred shares that we would issue if we were given authorization would be refundable. It would be possible after 5 years, and with the authorization of the Insurance and Mutual Companies Authority, if, of course, profitability is over 100 after refund. Thomas Carla, GFI Hebdo, you have mentioned a savings plan involving UK, US, and Japan of approximately 200 million euros. Maybe I'm wrong, he says. Could we have the details regarding this savings plan? Does this involve reducing the number of employees? As always in the group, we have productivity plans and savings quest plans. What you have mentioned here as regards life insurance is true, but we are trying to increase the group's productivity. A certain number of these plans were accelerated, particularly as regards asset management, to face up to the turnaround in the financial situation. And in some areas, this may lead to reducing our staff, sometimes through voluntary departures, and sometimes perhaps through less positive approaches. In the US and in the UK, this, of course, this corresponds to plans that have already been announced. Any other questions? Well, if you have no further questions, yes. Last one. Are you preparing a plan for France, for Germany, if 2009 is a real disaster? Well, you know, continental Europe business is extremely satisfactory. The perspectives for the future, despite a very difficult situation, are quite reasonable, and teams are permanently seeking productivity gains. But I do not think that we need to mention any disastrous scenarios for the future. Thank you all very much. Have a good day.